Next, we're going to talk about forms of business. So the three main forms of business are a sole proprietorship, where we have a single owner, a partnership, where we have two or more owners that share ownership in an organization, and then a corporation. A corporation has multiple owners who are called stockholders and purchase stock in a company. The amount of stock they hold determines their percentage of ownership. In a partnership, your percentage of ownership is determined by a legal documentation called a partnership agreement. A limited liability company can be formed by either a sole proprietorship or a partnership. What a limited liability company offers is asset protection. Sole proprietors and partnerships have what is called unlimited liability. This means that if their business took on a significant amount of debt, or if their business was sued for any purpose, that the owners in a sole proprietorship or a partnership, personal assets would be at risk to cover that debt. So, for example, if I am a business owner and I fall into debt, that debt for my business, they can force me to sell my home to pay off that debt. If I incorporate and form a limited liability company, then my personal assets are protected from the business debts. For most of this class, we are going to be looking at accounting transactions as if our company is a corporation. Accounting constraints, we have cost benefit and materiality. These two constraints go together. The cost benefit constraint says that we need to weigh the cost benefit when we look at how much information we're going to disclose. So for example, if our accounting records are off by a penny, we would look at that cost benefit analysis. How important is it that we spend hours poring through the accounting records trying to find a penny? It's going to cost a significant amount of money versus the benefit of finding that penny. Materiality helps us influence our decisions. So there are going to be a couple of accounting treatments where we have to decide one way or the other how that accounting treatment gets happened. One of the things that will happen is in chapters 4 and 5 when we talk about inventory. And deciding which accounting rule to follow depends on materiality. Materiality is different for every company. So under materiality, we have only information that would influence the decisions of a reasonable person need to be disclosed. So materiality is also an amount. Again, we come down to the penny thing, or one of the examples that I like to use is a $50 bill lying on the sidewalk. If you are walking down the sidewalk and you see a $50 bill on the ground, would you pick it up? If the answer is yes, you would bend over and pick it up, then $50 is material to you. So if you have information that is $50 or more, you need to report that. That is a material amount. On the other hand, Jeff Bezos, who is the CEO and owner of Amazon. Jeff Bezos makes $2,500 per second. If Jeff Bezos was walking down the sidewalk and saw a $50 bill, it would actually cost him money to bend over and pick it up. $50 is not material to Jeff Bezos or Amazon. So that's where we have to, these are subjective rules that we have to decide based on the size of our company, the size of the amount, and the information. Next, we're going to talk about the accounting equation. So the accounting equation says that assets equal liabilities plus equity. This is the main rule in accounting. Anytime that we record a transaction or make an accounting statement, this needs to be true. Assets must equal liabilities plus equity. The expanded accounting equation expands the equity section. So equity includes common stock and retained earnings. Contributed capital is money that the owners put into a company. For a corporation, that is called common stock. Retained earnings is the income that a company has earned, saved up since the beginning of the time that the company has existed, minus any dividends that have been paid out to shareholders. Retained earnings is made up of net income, and net income is created by our revenues minus our expenses. So assets are things that the company owns that benefit the business. Things that fall under assets are cash, land, equipment, buildings, vehicles, anything that a company owns to use, supplies. Liabilities are things that we owe to other people. This is our debt. This is when we owe employees wages. We owe the bank money for our mortgage. We owe suppliers because we bought items on credit. And equity, I talked about, is our stockholders and our stock and retained earnings. We're going to talk more about common stock in later chapters. Otherwise, we'll just be talking in the first couple of chapters about its existence and how it affects accounting transactions. We'll get really deep into it in chapter 11. Then we have financial statements. So there are four main financial statements in accounting. The first one is the income statement. These financial statements have to be prepared in order, starting with the income statement. The income statement describes the revenues and expenses that happen over a period of time. So revenues minus expenses equals net income. So that's how we get that it's called an income statement. Our statement of retained earnings explains the changes in the retained earnings account. So we have our previous retained earnings, we add that period's net income or loss, and then we subtract any dividends we paid out during that period. And we have a balance sheet. The balance sheet is the accounting equation. On our balance sheet, we make a list of all of our asset accounts, all of our liability accounts, and all of our equity accounts. We write what the total is on that day, and our assets should equal our liabilities plus equity. So the balance sheet shows the accounting equation. Then we have the statement of cash flows. The statement of cash flows explains how we use cash as a business and what our cash flows are for each period of time. Chapter 12 covers the statement of cash flows. We will start creating the other statements in chapter 3. We will not talk about the statement of cash flows again until chapter 12. The next couple of slides show the financial statements and how they are connected. So we start with the income statement. The income statement we have revenues minus our expenses gives us our net income. That net income is then part of the statement of retained earnings. From the statement of retained earnings, that information goes to our balance sheet. And then the statement of cash flows explains the amount of money in our cash account on our balance sheet. That is the end of chapter 1.